Hello. Well, today, thanks for joining us. We're going to talk about scenarios that we put together to manage our clients' portfolio. And there's three scenarios. Inflation roll down is the first scenario, in-your-face inflation, or blah inflation. So we're going to concentrate on the inflation roll down scenario. But first, before we do, let's take a look and just catch up where the markets are today. You can see, and today, if you look at your screens, you'll notice that we're back down to the lows where we are. So markets are down. U.S. equities 15%, fixed income down 10%. Fixed income is bonds. International stocks are down 15 or 16. Large cap growth companies, these are down 26, but many of them, Facebook, Netflix, 40, 50, 60% decline. Gold interest rate down negative 1%, yet we've got inflation at 8%. What gives with that? And then commodities up 35, 36%, quite on a run. And of course, you see the headline inflation at 8%. So quite a volatile year. No question, the last 3 years have been volatile. We don't mind the volatility and upside. We just don't like it on the downside. But pretty tough stuff. And so we're going to get into maybe some of the characteristics of what's going on. Just before we get into some of the characteristics, look at the bond. This is a chart March 31st, okay? And on the far right over here is the 31st. See, bonds are down 4%. Bonds are supposed to be the safe asset, right? Not go down. Well, in the 50, 60-year history that we've got good data, the lowest point was bonds are down 9% on the far left back in the 70s. Today, we're down over 10% bonds. So this is the worst bond market performance we've ever had and recorded. So, interest rates, we've talked a lot about this with clients. Interest rates were 0 or 1%. When they go from 1 to 2, that's 100% gain, right? Versus 30 years ago, they were 7%, they go to 78%. 1% is the same change, but the rate of change is significant. So big news in the bond market's pretty tough. There's some characteristics that we want to point out. You'll see the first chart. This is just a 2-year chart. What's going on with inflation? Well, money growth, money supply to the economy. Money growth is massive here in the pandemic. You see this big spike. The central banks of all around the world just injected massive cash into the system. Even 1 year ago, look in May of 20, it looks low, but it's a 20% annualized rate of growth even 1 year ago. Today, you'll see over here in the far right corner, it's about 1% annualized growth. And in June, we think it's going to be about a negative growth because the Federal Reserve is extracting all the money they put back in. This next chart is average hourly earnings. Kind of the same chart, looks redundant, but if you'll see here, pandemic, remember all the government and fiscal support that came that just paid just massive money sent out from the system, whether it be money or jobs or loans or whatever it was, and then that slowed. And hourly earnings, even 1 year ago, was running 8 to 10% increase on earnings. Now it's down to the 3 to 4% range. But again, these things are still massive changes. And then you'll see up here the federal spending, government spending. And this is what you see, massive deficits. Last 2 years, 20 and 21, this chart's a little outdated. Over $3 trillion of excess money that the government spent in excess of what they brought in. And of course, you see in the last 20 years, it's been quite that way. This causes big deficits. So all these things, no wonder we have inflation, right? Here's inflation printed last month in April. You'll see in the far right, 8.3%. The only time we've been this high in the recent 50, 60-year data is back in the 70s. You see that in the middle. And today we're at 8.3. A month before 8.5. No wonder we have inflation, right? Because of all the monies and all the stuff. Then you add the supply chains that's been taken away. There's not enough goods or not enough service. So all these things have combined, have caused some inflation. And now what we're trying to do is fix it. And real wage growth. This is a really terrible, this is the worst news of the chart in here. What does real wage growth mean? It means if you have inflation of 8%, and your wages are going up 3%, you've got a negative 5%. And so even though you're getting raises much more than you did 10 years ago, 3, 4, 5%, you're falling behind because the cost of living is increasing at a much faster rate. This is really bad news. And today it's less, today if you update this chart, it's below here. So 50-year run, it's really, really starting to hurt the American consumer. And you're starting to see that in the news. You see press releases. You see people where they're really starting to change their spending habits. Discretionary income, or spending rather, is really starting to subside, because when you're paying this for gasoline or utility cost or travel, you don't have the money to do other things. So it really is starting to impact a lot. Interest rates, oh my goodness. I could go back 50, 60 years, but let's just concentrate in the last year and a half. 1 year ago, the 1 and 2 and 10-year Treasury, the 1 and 2, you see the red and blue lines, 0.5% of 1%. That's called 5 basis points. It's almost zero. Well, the central bank came out in November, December of last year, the Federal Reserve, and said, we're going to raise interest rates. We got to stop this inflation thing. We're going to take it to 2.5% and 2.75%. Well, what happened? Voila, the bond market in 4 or 5 months went directly to where the Fed said it's going to do. You've heard the phrase, go where the puck, skate to where the puck's going to go. It went boom. It went there. It's there, right? And so massive change. And of course, this is what's caused the bond market performance to be negative. I mean, when you have this massive change, we talked about this for years with clients. Look, when the interest rates are 0, 1, when that changes, there's going to be significant changes in values of assets and real estate and bond prices. And sure enough, it happened in about 5, 6, 7 months. So a lot of change. So this inflation roll down scenario is one of our 3. We're preparation people. We don't predict. We always say preparation, not prediction, because prediction is a pretty dicey game. If you're right, you can write a book and make a lot of money. But if you're wrong, you lose a lot of money. And we're in here to help clients continue to build money, whether it be a pension fund or a family. We're here. So preparation, we're always thinking preparation. What can go wrong? And this scenario is a roll down scenario, and I'm just going to read through them. Consumer spending is slowing because of the reasons I just mentioned, okay? Wage increases is slowing, still going up, but it's lessening that. Housing prices are certainly starting to roll down. You've got mortgage rates went from 3 to 5.5%, my goodness. So no wonder housing prices, the increase is going down. Commodity prices, the increase has definitely slowed. Money supply growth, I mentioned before, in June, it's going to be negative. It's extracting money. Of course, money, credit and money is fuel for the economy, right? You start up an engine, you need fuel. Well, money is a fuel for the economy. You extract it, it slows it down. New bank credit, that's the other part of money. It's slowing down. Federal government spending, certainly a lot less than it was, and source it need to. $3 trillion more than we bring it in. My goodness, you can't do that very long, and that's not. The U.S. dollar is very, very strong, up 8.5% for the year. That's also a slowing characteristic. And our supply chains, while they may be improving, they're only improving slowly, but we do think the next 6, 9, 12, 18 months that the supply chain will continue to improve in itself as we go forward. So you put all that together, we think there's about a 50% chance that we will see a roll down of inflation from 8.5 to 8.3, which is now, maybe to 8, 7.5, 6. So 12 months from now, maybe we're sitting around 4, 4.5 to 5. Now, we'll see what happens. Today, the market doesn't think so. The market's down 4% on the stock market. If you look at the screen, don't look. You got another hour and into it. But the point being, it's back down to where it was a week and a half ago. So from an inflation standpoint, if we're right, and we do have this scenario plays out, that risk assets, stocks, real estate, are very attractively priced today. Okay, we've had a big change in pricing, 9 months to 12 months. The market's readjusted a lot. And so your forward returns are a much better place today than they were before. It was overpriced. I know clients, you are tired of hearing us say that, and it finally corrected pretty hard. So we're not necessarily afraid of it. Likely peak of market interest rates. We probably think that they got to where the puck was going. They're already there, and the economy is slowing. And just to show you in a chart, use this. If you were to draw a line, I'm not going to be able to draw a straight line, but if you follow me, this is a 10-year chart back from 2012, S&P 500 prices. And if you just draw that line, you know where you're at? Exactly where we're at today, 4,000 in the S&P. So that line eradicates and removes the big down, and it takes away the big top. It's on the same plane that it's been on for 10 years. So it's kind of interesting to me. Don't know what it means, but it is interesting. We're back to where we started. So here, the last 2 scenarios that we've included, we're not going to talk today. We'll come back and revisit these, but in your face inflation scenario where inflation just doesn't go away. It's stubborn. And then the third scenario, which we're planning on and to do some modeling, is the blah scenario, which means everything just goes just flat, no growth, no nothing. And that's a far more dangerous situation. And really, that's a 2024 era, 23, 24 era, and we'll talk more of that as we come. And then lastly, our favorite statistic for MCF, our internal, is client retention. And you'll see here 15 years of our assets under management. This is our client assets and been quite unbelievable growth. You'll see here we were close to $3 billion in assets under management on behalf of Kentuckians and Ohioans and people all over for that matter. We're pretty good sized player in Kentucky, and we're fortunate to have you as clients. We love you, we appreciate you. And remember, all this is about preparation. It's not about prediction. We have no idea what's going to happen tomorrow, but I can tell you over the long run, if we do our preparation, we will survive. We'll continue to build the portfolios, and the volatility in the last 40 years has been incredible, and it's not any easier any time, and it's no different this time, but it didn't put the end to us in 08, didn't put it in pandemic, didn't do it in the 87, didn't do it in the 80s, and didn't do it in the 70s. And we've had wars, we've had all these things, and markets are very fickle, and most of us, we just have to try to have good behavior. So thanks for joining, and we'll talk soon about the other scenarios. Take care.